Good morning or good afternoon, everyone. Thank you for joining us to the Pieces of the Puzzle webinar today, navigating market volatility and in the SFR and BFR and SFR and BFR strategies. We're lucky to be hosted today with an esteemed panel with RCN Capital, John Burns Research and Consulting, and Unitas Financial Services, along with SFRhub Marketplace. Before we get into the initial presentation today, we're just going to do a quick round of introductions, starting with Chris Dorin.
Thank you, Mike. I'm Chris Dorin. I'm Senior Vice President of Sales at RCN Capital, overseeing the origination operations of our large private lending firm, specializing in fix and flip, ground-up construction, and DSCR loans.
Thank you, Chris. We'll go to Don Walker next.
Well, first, Michael, thanks for having me. I do enjoy talking about SFR and BTR, so I'm really happy to be here. So, Don Walker, I'm a managing principal at John Burns Research and Consulting. We have two sides to our business, research and consulting. I spend most of my time on the consulting side, but our research team produces reports that cover all things housing. We have market-specific reports, and then we have topic-specific reports. And relevant to today's conversation, we do cover the SFR space as well as the rental communities. That includes apartments and BTR. And then on the consulting side, we do market studies for sale housing and rental housing. And again, focusing on this webinar, since 2018, we've completed 1,500 market studies around the country. We have a database of 3,600 active and planned built-to-rent communities. Wow. We do a national tenant survey, and we also do investor surveys. So thanks again for having me, Michael.
Yeah, thank you, Don. Wealth of information coming out of John Burns, everyone. So check them out if you don't already. And last but not least, big topic of the last couple of years, insurance. And John Watt will be speaking with us. John?
Well, thanks very much, Michael. Again, John Watt, and I am the program manager for Unitas Financial, and that is the real estate investor division, and we have all insurance products for not only SFR, BTR, but we can do multifamily as well, and hopefully we can give some good information and help on how we can stabilize all these insurance challenges that we're going through.
I'm sure you'll have plenty of good advice. Before we get into our discussion today, we're fortunate enough that Don has put some slides together to just share some general market information before we get into our discussion. So Don, feel free to grab the screen and kick it off. This will be about 10 minutes, and then we'll follow up with a 50-minute discussion.
All right, Michael, just a thumbs up when it shows up. Can you see it?
You're good to go. Thank you.
All right. So the hardest part for me in preparing for this is keeping it down to 10 minutes. So I'm going to go fast. If anybody wants the slides, just shoot me a note. My email's here. I also have a QR code at the back. So what we're going to cover today are some pretty dramatic demographic trends that are impacting housing. We're going to also cover at a high level what's going on in the single-family rental market. That's the scattered SFR. And then last but not least, we'll cover build-to-rent trends. So I'm starting with this slide. It's a map of the United States, and it's showing net domestic migration trends. And this is something that our research team updates monthly. And I will tell you that the reason why I'm starting it is because we had an abundant domestic migration happening in 21 and 22, fueled by all the stimulus that came from the pandemic. But the domestic migration has slowed dramatically. So it's kind of good news if you're from California, where I'm at. Not so good news if you're in Dallas, where people were leaving California and going to Dallas to find cheaper housing and more jobs. So that has slowed dramatically. So what we're saying to our clients is keep a very close eye on what's going on with domestic migration. Now, the good news is that we've had a surge in population growth. And as you can see on this graph, we think we grew by about 3.5 million people in 2023. I think the census estimate's still at 2.1. We think they're dramatically understating immigration, some of it, obviously, a lot of it actually undocumented. But there's good and bad for that, right? So the good news is it could improve labor supply, especially to build homes, which will help with inflation, which will help with interest rates. More housing demand, namely for rentals, and also stronger sales to wealthy foreign-born buyers that are typically ending up in some of the gateway cities. And so that's this next graph. This is showing where all those immigrants typically land. So in 23, 51% of that 3± million people that came to the United States ended up in Florida, California, Texas, New York, and Massachusetts. So what that has done is it's kind of masked the fact that domestic migration has slowed down. But what you have to be recognized is that if somebody moves from California to Dallas or Austin or Phoenix, they might have a different income than somebody that's moving in from another country. So affordability is probably going to get impacted here. And that's probably why, one of the reasons why we're seeing some pretty dramatic slowdown in rent growth in some of these markets. All right, so the other thing that we assumed, and we do have a chief demographer on staff and a whole demographic team that studies this, we thought that international migration was going to stay strong through 24. But there's been three policies, government policies, that we think are going to curtail some of that immigration. So we are updating our long-term demand model, but I want to show you what our current print is. So our team thinks that we need 18.6 million homes over the next 10 years. 13.7 of those come from household formation. We're going to need an additional 500,000 second homes. And a lot of people forget about tear downs. So you might have economic obsolescence, but we also lose homes to natural disasters and things like that. So we think over that 10-year period, we need 2.3 there. And then our team also studied the undersupply. We're in the camp of about 2.1 million undersupplied homes. So when you add all those pieces together, it's 18.6, or about almost 1.9 million a year. And we then break that down into demand for rental housing as well as for sale. And you can see our forecast for the next 5 years is that we're going to need 484,000 new rental homes to satisfy demand. And when I first saw this, I thought the 2019 to 2023 number must have been wrong. But really what happened was we had a lot of people that had bought distressed homes coming out of the Great Recession. They rode the wave of inflation and price appreciation, and they sold about 1 million homes over that period. So that's why it looks flat. All right. Now I'm going to pivot and talk about the single family rental trends. And we cover 99 markets. Again, every month we're tracking occupancy rates, rent rates, et cetera. And this is our forecast of what we think is going to happen with single family rents. These are scattered single family rental homes, not build to rent homes. And so the dark green are markets where we think rents will be greater than 5%. And then on the red side would be less than 1%. But you can see nobody's really red. We have an orange there, but we're basically saying every market should remain positive from a rent growth perspective in 2024. But that rent growth, as a lot of you probably know, has certainly slowed. And so this is just showing the top 20 markets. And on the left-hand side, you can see the year-over-year rent growth as of April 23. On the right-hand side, year-over-year rent growth, April 24. And you can see that pretty much across the board, pretty dramatic slowdown in rent growth. And I think that's a lot of that's due to the bite of inflation. Everybody's wallets have been squeezed because of gas, food, et cetera. And there's just not as much to go around to cover everything, including housing. And then this is the rest of the 99 markets that we cover. Fairly same story here. A lot of them showing slowdown in rent growth from a year ago. All right, so this is the historical occupancy rate for scattered single family rental homes. The average was 94.5%. That's right where we're at now. So we got above that long-term average in 21, 22, but that has since tapered back down to 94.5%. Not bad, but not quite as hot as we were a couple years ago. And this is our national forecast for single-family rent growth. You can see we spiked in 21, 22 at almost 8%. That growth has slowed down a lot, but we're thinking rents are going to grow about 3.6% overall this year, 3.7% in 25. And now pivoting to the build-to-rent space. Starting with this graphic, because it's important to define, for us to define how we look at build-to-rent. So we include horizontal apartments or cottage homes, much better marketing name, single-level row homes, and townhomes, like your traditional 2- and 3-story townhomes. We break those out separately because the demographic profile in those homes are totally different. And then we also obviously have single-family detached. Now, we also have created another category because we're seeing more and more of this, and that's mixed product communities. So we're doing a ton of studies on projects that have 2 or 3 or even 4 different BTR products within the same project. And also to fit into our database, it's got to be a dedicated rental community and at least 25 units. So if D.R. Horton sells 10 homes to an investor out of 100 units for sale to subdivision, we don't count that as a build-to-rent community because it's not dedicated. We count that in the scattered SFR realm. So that's important, again, for some slides that I'm going to talk about a little bit later. So each quarter, we survey land brokers around the country about what's going on with who's buying land. And in this graph I'm showing now is who's buying finished lots. And again, relevant to the conversation today, focus on the purple color. That's the share of finished lots being sold to built-to-rent operators. So back in 2020, it hardly registered, got up to 5% in 21, got up to 16% in the third quarter of 22. But then when interest rates spiked, cap rates spiked, rent growth slowed, the number of finished lots being acquired has dropped dramatically. In fact, we're seeing some BTR projects are now selling their lots to for sale builders. But what this tells me is similar to what we're hearing from our friends in the space anecdotally, that starts are going to be down 50 to 80%. And if you're not buying lots, your starts are going to be down. So this drop here since the last year is about a 60% decline. So that kind of supports the anecdotal evidence. Then our clients have been asking us about supply, BTR supply, starts and completions. And so our research team and I have been working on this for quite a while now. And so what we're showing here are the average monthly starts by quarter. And so let's focus on what's happened in the second quarter of 23. We were starting as an industry about 6,000 units a month. Again, this is based on our definition of what a build-to-rent home is. But that has dropped to only 2,500 as of the second quarter of 24. So a pretty big decline in starts, 57%. Now, here we're breaking out completions. And so you can see coming out of the pandemic, people loved moving into build-to-rent homes and the builders responded. And we were building, again, about 6,000, a little over 6,000 homes at the peak. And here we're breaking out by color. So you can see townhomes have still been one of the dominant products in the market. But now we're at under 5,500. And based on the projects, again, in our data set, and we work with Yardi and RealPage to get a lot of this data, plus our own consulting work. If we don't start new projects, these are all going to wear off by the end of 26. So you can see 23, we delivered around 68,000 units. 24, we're forecasting 59,000. But again, if we don't start a bunch of new projects, we're only going to see 22,000 units delivered in 25. So that's kind of good news for the industry. We just need to get the capital markets to behave and get some of these projects going. Okay, and so again, as I talked about, we also have our own rent indices for build to rent, apartments, and scattered SFR. This is a comparison of the history of those. So again, the dark blue line is build to rent. Rents grew by almost 20% on a year-over-year basis coming out of the pandemic. Apartments hit 15%, scattered SFR got up to 8%. But as that supply wave of BTR and apartments was starting to hit the market, rent growth slowed. And apartments got really almost down to zero, but they're both bouncing. BTR and apartments are starting to bounce back a little bit right now. We're estimating that BTR rents are up 1.7% year over year, and apartments are 0.7%. And then you can see our forecast, it does get a little bit more bullish as we get out past 25 and 26. Again, because of that supply story I just went through. And last but not least, every year we do an update of our build to rent premium analyses. And so again, for the essence of time, I'm only going to cover the horizontal apartments here. And here we compare against garden style apartments. And you can see we've been doing this since 19. And in our latest print here, we think horizontal apartments have a typical premium of 18%. We don't do this to say what the percentage is. We do this as a case study. As you can see on the right-hand side here, there's a big difference in premiums, and it's all due to the execution of the build-to-rent project versus the quality of the garden apartment that it's next to. So the good news is, looking at same-store comparisons for the past 5+ years, is that horizontal apartment premium has stayed fairly level at around 18 to 19%. So here's my QR. If you'd like those slides, happy to send them to you. Just send me a note. And Michael, I'm going to stop sharing now.
Great. Well, Don, really appreciate all the insight there. And, I think you kind of nailed it. If anybody has the magic wand to make the capital markets behave, you'll be very rich. So
well, I'll say this, Michael, we just completed our annual build to rent underwriting survey. And in there, we're asking about how does the capital market feel from a debt and equity standpoint? And we're starting to see some green shoots, some capital's coming back, and some people are getting very creative on financing projects. And I'm sure Chris has a lot more details than I do.
Yeah, no, we look forward to hearing that from Chris, and I agree on that. Been seeing that in the market as well. So leading in, post Don's presentation here, we're gonna go through a few topics. First one being market volatility, and discussing the current conditions and the factors contributing to the volatility in the SFR and BFR markets. And Chris, I think this is a good one for you to kick off on, and John, it'd be great to get your follow-up because insurance is obviously playing a big factor in this as well.
Yeah, there's a lot of factors that we see playing into that volatility in the market. You hit on insurance there being a big one. Certain parts of the country are seeing taxes go up as well. So those rental property investors, they're seeing it from both sides on the expense ratios of their cash flowing property. So that's been a challenge for some folks as well. But, part of it too is the psychology of the people who are in the market to buy. And when they see that market volatility has actually stabilized a little bit and they feel the confidence to jump back in and start pursuing real estate again, that might be a little different than what our expectations might be too, right? We've seen rates come down recently a little bit in the marketplace, and yet you haven't seen a big rush to jump back in the market yet. People have seen this before. I think they're likely sitting on the sidelines. A lot of people waiting to see a little bit more movement and stability from that side of the market. So when those conventional home buyers are maybe sitting out a little bit because so many of them are in a good position with their existing home and mortgage, that's an opportunity for investors, though, to come into the space. Investors have an opportunity in this market to be in a buyer's market and really negotiate those sales better, right? We've talked about it, for years and years and years for investor community, but, buying the property at the right price point is really the key to getting so many of these properties to cash flow property, or if you're a flip investor, to make that profit on the sales side of the transaction. But, seeing that opportunity for investors to not shy away from the space and think that they have to sit on the sidelines, but they actually have a lot of opportunity here to take advantage of those sellers who are distressed in some way or need to move for a particular reason, there's more open opportunity there for some negotiations too. So, as we see the volatility maybe have some negative impacts on the market, there are, signs of life in there that allow us to, really see opportunities for investors too.
Yeah, no, I think that's a good point for the investors to, to keep in mind that, on the opportunity to help, some of the investors that, just got put in a tight spot in 21 or 22, depending on their SFR or BFR strategy and where they're at today. Oftentimes it's less than a 5-year strategy. And, many groups are going to struggle to hit their exit today. If anybody that lived through 2008, they know that sometimes it's better to break even, and that's a win, than go down with the ship. So, which is an opportunity for buyers. John, can you discuss some of the volatility in the insurance market and just the overall climate?
Sure, Michael. I think first of all, real quickly on the why is insurance more expensive than it was fairly recently? On the property insurance side, first of all, the values of the properties are higher. The materials cost of whether it's wood or any other products, labor, everything else. So the cost to repair a damaged property is so much higher than what it was, say pre-2021. Then in addition to that, we're seeing severity of losses go up as well. Whether it's in the center of the country from weather events, whether it's in the population dense areas where we see increased fire risk and so forth. And we also saw at the end of COVID, we saw a tremendous increase in the number of liability claims that are coming in, particularly in population dense areas where, it's something, it might be as simple as a trip over a sidewalk, but then we get a personal injury attorney involved and so forth. And there that claim goes to a couple of $100,000. Well, now you have that on your record and your insurance prices are going to skyrocket. So, it's been just like a lot of the other areas in SFR, it's getting hits from all sides, and there, and we'll talk about it. There are some things that we can do to stabilize it, but that's what's caused all the market volatility.
Yeah, now the slippery sidewalk attorneys don't help.
No, not at all.
Yeah, Don, aside from insurance and lending, which are obviously, two big factors, capital markets, taxes and insurance, do you have any other thoughts on factors contributing to the volatility in the SFR and BFR market that
I think I'm going to go back to the demographics that I started with, Michael, and that has really changed a lot. And so I think that's contributing to some pretty big differences in home price growth as well as rent growth, market by market. And so, I can't stress enough that people really need to pay attention to demographics in their local area because it is changing in a lot of markets.
Yeah, no, that's a great point. Regarding interest rate changes, and obviously there's been a lot of fluctuating, and this is one of the biggest factors in the slowdown of both BFR acquisitions and single family portfolio sales. I think it's become self-evident that, the MLS is being used as a tool today to, for the large operators to move homes one-off. They're not selling portfolios. And the investors that are acquiring homes are also, utilizing the MLS much more than buying in bulk today. But Chris, maybe give, kind of all the investors and everybody listening in just sort of an idea of where current interest rates are, both for, SFR portfolios of 20, 50, 100, 500 homes and build for rent communities and what tactics can be used to, buy down interest rates, trying to get a better debt service coverage ratio.
And you see that in particular too, creatively, I think on the new construction side of things, We've seen plenty of builders who go out to market and, they're buying down interest rates on behalf of buyers, right? So we've actually seen some new home builders who go out there and they'll market the homes and market the financing with it. Hey, we can get you 4.99 rate. I've seen 5.99 rates and things like that. So they're trying to do what their part to attract these investors. Part of that, I think, is also to try to maintain the price point that they're selling the homes for, because your sold price will still be at that same value that you anticipated, and yet you're still giving the customer something by buying down that mortgage for them.
Right.
So a little bit of seller concessions there on that side goes a long way for it. But right now, what we're seeing in the DSCR markets, rates have come down a bit. A lot of stuff we're seeing now is still in the 7s in that market, whereas conventional stuff's probably more in the high 6s right now. But that spread between where we see conventional rates and kind of the DSCR markets for rates have really been pretty close for the last few years together. They seem to move pretty well in conjunction with each other. But again, if you're a real estate investor who's looking to expand a rental portfolio, the rates of the day are still the rates of the day. Your property taxes, your insurance costs, those are all fixed things in there for the most part. What you're looking at there is to find opportunities for cash flow. And if you can build that into your model, then it can be a good property for you to own and manage, right? But it's not like it was in 2021, as Don and John both alluded to, right? Those were high time markets where even a lay investor who's just getting into the space could have done very well, because you saw home price appreciation really going up fast. You saw rental rates really rising fast. That brought a lot of people to the market who were very excited about it. And that brought different kinds of people to the market too, right? You have your long-term rental investors who take that model, but there are a lot of people who flooded into that Airbnb market too. And that has also thrown a bit of a wrench into how real estate behaves and how people's attitudes have changed a little bit too. So it'll be interesting to see how those factors play out on a longer scale of time here, because that's still a relatively new thing on the scale that it's been, right? We've seen, vacation homes and vacation rentals over the years, but the scale and the growth of that Airbnb market really changed things, and how people are approaching those properties too. But for the investors to, still participate in the existing market, they shouldn't be shied about, those interest rates that are out there. Yeah, they're a little higher than they've probably been comfortable the last few years, but it just means you have to run your numbers and make sure they're, very solid for yourself, right? There's still opportunities in the market. And again, to Don's point, a lot of that is very demographic and regional as well, right? There are parts of the country where it's really affordable to buy a single family home and rent it out. There are other parts of the country where, because of the tax costs, the insurance costs, and maybe just the high cost of that property, plus the high rate of interest rates right now, it's not going to be viable for a single unit property to rent out on a cash flowing basis. You might be looking more at, multifamily homes in those markets to get that cash flow that you're looking for. So, a lot of it does depend on where that person is, right? If you're investing in, the Sun Belt and the southeast of the country, there's a lot of great opportunities in those markets. If you're in California and New York as a rental investor, maybe you're looking only more along the lines of multifamilies, or you're looking for maybe a different play there where you're looking to maybe tread water with your cash flow for a couple of years and then see the home price appreciation and that you're hoping to cash in down the road. We've seen investors do that and use that as a tax vehicle to even write off some of their losses that way.
Yeah, those are all good points. Curious, Chris, what are you, what are you seeing from the capital markets, and specifically the lenders, and how they're looking at stabilized SFR, and maybe even stabilized BFR? There clearly aren't as many of those, but let's say it's 100 home SFR portfolio, cash flow is X. Are lenders starting to loosen up a bit on looking at forward growth, or is everything today still, here's where the current NOI is, and we're willing to loan X because that's the NOI? Are they taking any value add into consideration yet?
Yeah, it seems like we're coming to the inflection point on some of that stuff. I think there's signs in the market where you're seeing some of that stuff start to give indications that you might get a little bit of an opening up there. But everybody's been kind of, I think, at the same time, a little bit gun shy because of the volatility that we've seen, right? If you look at the treasuries, they've been bouncing around up and down, up and down. And that volatility and the spread that we see between, say, a 10-year treasury and where the conventional rates are now, right? We need to see some rate compression there, just let alone what we see from the Fed's activity, right? That rate compression is going to be critical for us, because despite the Fed's opportunities to maybe go out there, lower interest rates, well, we also as a nation have to pay our debts. And, we're going to be issuing more bonds going forward. The market's going to demand a certain yield for those bonds too. That's going to, keep those mortgage rates probably a little higher and a little longer than people are anticipating maybe, right? And so, yeah, with those bigger portfolios, there is a little bit of an extra risk there, right? You're underwriting those a little bit differently because you see, if you have an investor or a particular, area that's really concentrated with a lot of properties where one investor is trying to, leverage those properties, there's added risk there. If something happens to that investor or to that area, those properties, you got a lot of exposure as a lender. And I think that's an area where you're seeing some different approaches get taken there. You're seeing some lenders try to underwrite files a little differently to account for some of that stuff too. Vacancies playing more of a factor nowadays too. A lot of these investors are, buying homes or building homes and then trying to convert them into rentals. But you got to put a tent in there and kind of prove the model out first at a certain point too, because that vacancy is going to play a factor. And if you get a vacancy, you might see a lower LTV option on those loans.
Yeah, no, that makes sense. Fortunately, like Don mentioned, it looks like occupancy is huddling, around 90, just below 95%, which is still pretty good. Before we get into some of the insurance solutions on these volatile times, Don, just curious, given the broad, scope that you have access to and the operators that you speak to on a daily basis, regarding, the SFR and BFR investments and any strategies to mitigate risks and impacts of fluctuating interest rates. Have you, what are you seeing, from all the people that you're talking to, or are you seeing any new sort of strategies kind of pop up that look promising?
I guess what I'll talk about is the distress side of the market, because people were expecting distress early on.
Yeah.
In our underwriting survey this year, Michael, I asked a question, and we had 60 responses to it, and all pretty big institutional level sponsors as well as capital providers. And the overwhelming majority, 70%, almost 70%, said they did not expect to see a material increase in the number of distressed projects hitting the market. This is built to rent. But what we are seeing are recapitalizations. And so they're not, and I think that's because the fundamentals are strong. It's really a capital issue, right? So they've been squeezed on the capital play. And so projects are getting recapitalized. The sponsor is able to hang on and hope for a better day, year, 2 or 3 years from now. So we're seeing a lot of capital looking for opportunities like that.
Any particular instruments? Is it preferred equity, or starting to see more mezz debt?
I think it's coming in as primarily equity and maybe a refinance with the lender. So it's a case by case, as you can imagine.
Sure.
Yeah.
John, regarding insurance solutions for these times, and I know you've got plenty to say on this, and there's a number of ways of looking at, impacts on premiums, whether it's increased deductibles or coverage amounts, or, trying to mitigate, losses. But, can you share some thoughts and strategies that you're assisting clients with, both on the SFR and the BFR side?
Sure. I think, when we say best practices, that goes all the way through the operations with SFR, BTR, whatever. And what we mean on the insurance side for that is taking a look at the properties that you've got, make sure that they're in good repair. When somebody has an issue that you get it, I've got some water dripping. Okay, you can go over there and you can fix that. If you ignore it, you wind up having a great big water damage leak, claim or something like that. But just keeping an eye out to try and reduce your potential effect of losses. We talked about, and we talk with our clients all the time about taking a look at insurance in a little bit different light. We need to look at it a little bit more on the catastrophe side these days, rather than if somebody comes by and does a couple $1,000s worth of vandalism damage, or whether there's a small loss that might take a couple $1,000s to fix. You can self-insure for those. What you can't self-insure for is a house burning down all the way to the ground, or tremendous damage from a tree falling and going through the roof, or something along those lines. These need to be the losses that we're insuring against. And what I mean by that is, take a look at higher deductibles. Going from a $5,000 to a $10,000 deductible could save you 10% on your insurance premiums. Going even higher for the larger investor to 25,000, it might be another 10%. Okay, 20% doesn't sound like a phenomenal amount of money this year. Take a look at that over a 10-year period of time, and now we're talking about a huge effect. Yeah. Over the amount of money you're paying for insurance. And think of it this way: you're almost prepaying your losses, whether you have them or not, when you have a low deductible program. Yeah. Also, share with your insurance professional information about what you're doing. What's your tenant selection like? How can you dress it up where your particular operation is exceptional, and we can get additional credits, that give you a more attractive looking insurance premium rather than just the off the shelf rate. Make yourself look, you want to be an exceptional operator. Share that information with underwriters so that they feel the same way and they're willing to give you best value. And again, the way to do that is going to be to have a professional in the business. Not everybody understands SFR, BTR, multifamily, and so forth. Get yourself a trusted advisor that will do that. Yeah. And it'll be worthwhile.
That's interesting. So are you saying that providing some detail on the demographics of the tenant that you're trying to attract to your home can be a benefit?
It can, because depending on what you're doing with tenant selection, it most definitely has an impact on what losses are to come. Let's say, if you do credit checks, if you do background checks, where allowable by law and so forth. But your tenant screening process will make a difference on the amount of maintenance that you have to do and what your potential losses are. A careless tenant can cost you a lot of money. Not only in the loss itself, but you're going to get hit with that raise in insurance costs. So, I think it's key, and it also signals to the underwriters of insurance, okay, what kind of an operator do we have here? Are they detail oriented? Are they doing the things that they can do to make sure that you've got a stable account? And it's a big deal. We're just not in an environment where, okay, give me the cheapest rate I can find, that'll be great. That very rarely works.
Yeah, no.
I'm assuming, John, that if you have a history and you've been getting in the tenants that take care of the home along with you, that you should have a history of losses that are less than other operators. Is that something that you can share with the insurance brokers to help get a better rate?
Absolutely. That a loss-free account is, or a low loss account, you bought the insurance to, take care of any losses that you may have. And it's understood there will be some losses. There's no question about that. However, if it's, if it's on the high side of what the premium is, then, you're going to have a problem. When you have an account comes in that says, I don't know, 50, 100, 500 properties, and they see that account is, that it's profitable, by some spot check inspections, whether it's on Google or in person or anything, and you see that the properties are in good condition, it makes there's a tremendous difference in what the pricing on that is going to be versus just, okay, an off the shelf rate, that's just based on area and location and so forth. So there needs to be some work in the presentation of, hey, I'd like you to insure this for me. And, how do I get preferred rate rather than just, off the shelf?
Sure.
Yeah, it's interesting. And I'm sure somebody's some techie will come up with a solution for this because I think it's needed. But based on your demographic comment, everyone that's using whatever screening processes and fraud protection, unfortunately, all that data is only limited to people that have always had bad behavior. There doesn't seem to be a reward for tenants that have had good behavior. That would be something phenomenal to know as an operator. And I wouldn't be shocked that somebody comes up with that in the next couple of years, because I think it'd be beneficial for our industry. If we can talk about insurance real quick, based on the slide that Don went over, and Chris, will follow up with you because I think the lending is obviously different on it too. But for operators or just interested parties out there, John, considering horizontal apartments, row homes, attached town homes, and detached single family homes, how does the insurance market look at the premiums and structuring those deals, based on the kind of 4 different categories? And it sounds like per Don, we've got a 5th one starting to pop up now as well, which is exciting.
The scattered portfolios of SFR is going to get lowest premium because we've got quite a bit of diversity there. Any sort of a catastrophe event is probably not going to affect all of those properties. When we're looking at townhomes or row houses and so forth, there's a real challenge there from the on the fire exposure side, from the standpoint of if let's say you own 4 in a row or something like that, if one catches fire, are they all going to go? Even worse than that, on something that you can't control, is what if your neighbor has a fire? Now does your place burn down too? So there is an increased, fire rate on something like that. It's certainly manageable. And there again, information is key. That, does the construction of the home have firewalls in between the units and so forth? Make sure that your broker knows that, because it'll be a different fire rate on something like that.
Yeah.
When you're talking about well, let's go to BTR, build to rent. There is a concern there on the insurance side from the standpoint of, let's say we're building, I don't know, 100 or 200 units. Although they're not right next to each other, there is a tremendous concentration there. So that can drive availability. Actually, you'll have a lot of folks that'll step aside from that. But again, a competent insurance broker will bring in a couple of insurance companies to insure that risk. And now it's much more palatable to each one of them if they can share the risk, rather than taking on the entire, and I don't want to get too technical on that, but on any obstacle, there's a way around it, right? Yeah. And you just need somebody that knows what they're doing so that they can get that done for you. With the build to rent was to borrow someone else's phrase, it was the darling of the industry for quite a while. But of course, now you dig into it a little bit farther, there are some pitfalls, of course. And then finally, multifamily. Multifamily is, it can be very competitively priced, and you can have manageable insurance prices, but you're really going to have to keep an eye on your best practices and your loss control. That if somebody falls down the stairs, or they have a railing break or something like that, this is just so ripe for the personal injury attorneys and so forth. And hey, if somebody's injured on a property, they deserve compensation. However, the loss adjustment costs for these kinds of things, man, you just want to stay away from that. You don't want all the aggravation of liability claims and so forth. It's just no good. Did we cover all the areas there, Mike?
I think so. Chris, you have go ahead, Don.
I'm sorry, I've got a statement and a question for John. So on the demographic front, the people that live in the single level row homes are much more mature. So they're typically over 45. So when we talk about demographics and property type, that's where I clearly see an alignment. And then on the question on diversity of location or concentration, do they look at build to rent differently than apartments? I mean, I would assume apartments are even more concentrated than a single family detached build to rent community.
Well, they do. The construction's different on the multifamily, even though you have density in an apartment complex, the construction is different. There's one roof over a pretty good sized building. If we're talking about build to rent, now we've got 50 or 100 roofs there. So it's, just taking roofs, roof construction as an example, which would be on windstorm exposure, it's definitely different. And we're also talking about, the insurance industry considers 5 units and above a commercial risk. So you have a different group of insurance carriers that may come in. The 1 to 4 family, typically your commercial insurers are not involved in that type of construction and risk. So it's really a SFR and BTR are absolutely an insurance specialty, especially with the way that the industry has grown so much. So I know that was, it was a bit of a long answer to a short question, but those are the factors that are involved in it.
Yeah, no, it's important. Chris, any thoughts on, and I mean, I know you would know, but are the lenders looking at, essentially if it was an apples to apples deal, but one in a non, volatile area from an insurance perspective, and the other is, are they looking at, how they're structuring the loan, based on whether it's in a coastal market or infill Phoenix?
Well, yeah, you do see some differences there. Coastal markets in particular, right? It's not just that you're looking for the dwelling coverage on those, but do you have wind and hurricane coverage and things like that as well, right? So you might have higher requirements in some of those areas because you see those instances of claims go up on those too. And what we really see is we project out the insurance market issue and the rising premiums there. That will be more of a national issue as we go forward. Right now, we see it really heavily in a handful of states, though, especially for our business, like California, Texas, Florida, obviously 3 majorly populated states, 3 states that have a lot of activity in them. And yet those are also 3 states that we're seeing a lot of, insurance premium problems for investors who've owned properties for a number of years now. And then suddenly their rates are maybe going up 2 and 3x, and they're starting to look at their cash flow. If their rents aren't increasing at the same levels, you're having some people there who are maybe going to be looking to exit a couple of those rental properties too, because their numbers just aren't satisfactory for where they need them to be on the turnaround there. And I'd be interested in John's perspective on this too, would be, are you seeing, borrowers maybe who are trying on their own to maybe shortcut their own policies and coverages to try to minimize their premiums? And is that maybe going to be, penny wise, pound foolish when they do so, if they ever do wind up having a claim at some point?
Well, it's a good question. I think that certainly the lenders like RCN, are giving out pretty specific requirements on what it is that you guys require in order to get the loan closed. And we're seeing actually an agreement between the insurance industry and the lender like I've never seen before, from the standpoint of the valuation requirement between what the lenders are requiring and what the insurance industry requires. They're in lockstep right now, so I think the ability of the borrower to have an insurance program that's not going to perform or not in compliance with what you are requiring is going to be few and far between. Now the challenge is paying for it. Like you said, are we going to see people exiting areas because of what the insurance prices are? Maybe in the Florida or coastal areas, but I would also hang on because it's not going to last forever. At some point we'll see a resolution, and then whatever the challenges are now, it's going to get better. We've seen let's say on the rate side, insurance rate side, that we've seen. I think we've hit the high water mark based on everything that's going on today. Now, if something happens tomorrow, okay, all bets are off. But we're starting to see a softening of the rate increases and so forth. So hopefully we've hit the high mark there, and going forward, if we can get more competition in the marketplace, or at least keep prices static while rents go up and so forth, then I think it'll be a more palatable than it is now. Did that address it?
Yeah, I think that's right. And, I think you're right too about getting more companies in there for that diversity that you're looking for, right? To be able to share in the insurance risk if you need multiple carriers to jump in on a particular deal, spread that concentrated risk around a little bit. That'll be key, because as you see, some of these players pulling out of certain states, it does leave a bit of a void in that state for people to scramble around and figure out what they're going to do for their insurance coverage needs. And, you mentioned multifamily before, and I can recall we had a couple of multifamily people who property was cash flowing, and then they went to do a conventional refi on those, and their insurance requirements, as you said, got a little bit tougher and stricter, and suddenly those premiums really jumped on the investor, and they were like, why am I even going to hold this property if that's the level of cash flow that I'm getting off of this? So, I think for a lot of investors too, it's smart. Like you said, you should be talking to a professional as an investor and figuring out what your best opportunities are for the insurance coverage you need. I think if you're just going to your straight, whoever does your auto insurance policy and things like that, you're probably, not getting the right investment advice that you need from an insurance perspective.
I think I think that's right. And of course, not stepping in front of what we're going to speak of, a little bit later, but I think that, when you're doing your numbers on it, is a property going to perform? Don't take information from the seller, because you may not be able to reproduce that program of insurance. So you need to get some solid information, and your insurance professional will be able to give you a real good idea of where we are. Michael, we've talked about this for years, trying to give you all information on, okay, what can we expect on insurance? Well, okay, most of the country, it's somewhere between 0.5% and 1% of whatever the value is on the property. Get into Florida, it might be 4%. So it's just you need some expertise there, and that then you going in eyes wide open, then you've got your profitability set on the property without the big surprises like you just said, Chris.
Yeah, I think that all leads in really well to kind of the next couple topics. One was data-driven decision-making and forecasting market trends. We live in a world with data, at our hands, obviously, but, operating an SFR or a BFR portfolio has, I couldn't count up all the data points, but it is imperative, to do the best that you can in understanding your PM, costs and fees, lender costs and fees, insurance costs and fees, lawn care. I mean, just there's so much repair and maintenance. There's so much that goes into this, but, maybe, Chris, we'll start with you, and we'll just go around kind of the table here on data-driven decision-making, with the kind of intent on, helping investors think through forecasting, whether or not it's a good decision. But where do you see on your end the important data metrics for making a good decision? Then Don, we'll go to you and John following.
Yeah. I think a lot of that starts with a lot of what Don talked about in his early presentation too. It's where are people moving to? Where are the opportunities that rely on that market? But also where are people exiting from, right? And looking at those trends, and a a lot of the national numbers that we see for certain housing trends are maybe more on the flat level, but that's because we have certain markets that are doing really well and other markets that aren't. Maybe markets that ramped up too fast over a certain period of time, and now they're coming back down to earth a little bit, right? So you're seeing challenges in that as well. But I think it's an exciting time to be, an operator too, because you have more tools and resources and data at your fingertips than you ever had before. A lot of this stuff becomes public too, and people can really forecast out a lot better with better accuracy, I think, today than they ever could before. And there's so many, different providers who have resources you can tap into. There's great content and educational webinars and things like we're doing today, even that really just help inform the investor, because we're all in this space, and we all recognize that, one of the beauties of our industry is the ability to have repeat customers in the mortgage industry is definitely a nice benefit for what we do as an industry. And it's in everybody's vested interest to make sure that our clients, the borrowers themselves, these investors, are getting the proper guidance and being set up for success, right? We're always telling our team, listen, I don't want you to set anybody up for failure. I don't want you to put somebody into a property, into a loan that isn't going to work out for them, right? You need to sometimes protect people from their own worst instincts at times. And part of that is, using data from our side to share that with our customers, letting them know, hey, here's what we're seeing in the marketplace. And, where they may, be thinking, oh, well, I'm just going to keep raising rents, X percentage every year, but that's not viable. It really depends on the specifics of your market, knowing your market. And we've seen a lot of investors too have found opportunities to now go all across the nation, even though they might live in a different location too. That brings opportunity, but there's also challenges with that, right? Boots on the ground are an important part of any operation, and finding people that you can know, like, and trust to do those jobs is not always an easy thing either. We've had feedback from our client base too, that, one of the challenges that they're facing in this market is the ability to hire quality people. And that's not just on the contracting side, but it's anybody who's related to their book of business potentially. And so those are key factors that, people are going to, measure and rate the success of those employees too. And I think that's an important part of any piece of data analytics. It's not just, okay, we've made the decision based on these data points, but how are we going to continue to track this? Are we making sure that the models we're using are also appropriate? And have we adapted those models to fit what we're being told in response?
I in the vein of only having a few minutes left, and I'll let Don and John kind of tail end everything you just said based on really the last question and or comments that we can give to the public here. But I think you said something that was intrinsically important in that, you can gather all the data, you can have all your points laid out, but having trust in the teams that you select, which, you can only get that by trial and error. But that's forming that trust with all the independent, points that touch your operations is really key. With that said, thinking about tips and strategies for investors to protect their assets and capitalize on opportunities in uncertain times, would love to just everybody kind of give their 30-45 second pitch on how you see that. And Chris, we'll start with you, go to John, and then end with Don, because he is the information king.
I think one of the things I've seen from investors that have been more savvy in the current marketplace is to find those off-market deals and swim upstream for opportunities, right? If you really want to find a good opportunity, I think Don was saying it before, we're not going to see homes come on the market as this big inventory of distressed properties like we did after the 2008 market collapse. That's not in the cards. That inventory doesn't exist. People who own homes and have mortgages on them right now have a ton of equity. So even if they are a distressed borrower in some way, they're probably not seeing foreclosure because they can still sell the home and recoup that equity. So your opportunity as an investor there is to find those distressed borrowers, find people who are trying to get out of those homes, try to talk to them and negotiate that sale up front. You can get a really quality discounted sale. Maybe the home needs a little bit of work, but you can get into a quality property at a much lower cost of entry by just swimming upstream a little bit and getting into somebody's living room and sitting down with them and having a real conversation.
Yeah, I like that. You gotta get dirty to swim upstream. John?
On new purchases, deal with the facts and where they are right here, right now. You know, if you want, you need to get your insurance costs up early so that you're eyes wide open and you know what the expectations are. You know where your pricing has to be in order for you to have a profitable property. You know, it used to be an incidental expense. Now it's a big one. We're right next to taxes. You know, with the insurance costs for existing portfolios. If you've just been hit with a huge rate increase or you feel that you're paying too much, talk to your insurance professional or find an insurance professional that's got some different ideas on how those premiums can be reduced by making some modifications in your insurance program. You don't want to be undercovered, but by the same token, you don't want to be paying for losses before they happen.
Good point. Mr. Walker?
And those were all great points. And this, the topic that you were asking about, Michael, is right in line with really the foundation of our company. And that is, we're here to help investors make informed decisions. So we collect, analyze, and publish thousands and millions of bits of data, right? Some of that is from census, some of it is our own proprietary work and surveys. So we do things like survey tenants, build-to-rent tenants. And so we did our second annual build-to-rent tenant survey. We got over 8,000 responses. They're telling us what's motivating them to buy or not buy, to rent in a certain project. What do they want in a home? What do they want in the community? How long are they going to live there? So you can make an informed decision when you're designing your build-to-rent community. What should you be building? Then the big question that we've heard since day one on build-to-rent is, how do you measure supply? Well, we're getting better at that. And as I showed you earlier, I just gave you a peek of our national forecast for when those buildings that are under construction are going to wane and when those units are going to be delivered. We have that at the MSA level. So that should help investors say, and sponsors, look, we are going to have a housing shortage again. Get your timing right. So it's making informed decisions, and there's a ton of data out there. Almost too much. The challenge is going to be analyzing that data.
Yeah, no, I agree. I think you guys all made good points, and I'll just try to keep it simple. You know, from my perspective, you know, one, be patient. You know, two, don't think you're going to get rich on any deal, especially today. You know, if I always say to make money, you just got to be in the market. So you have to make decisions to go forward, you know, and everything that we discussed today, you know, getting all your ducks in a row, having all the facts based on the data, you know, narrowing it down to a few deals, and then just, you know, going forward with what you think the best deal is for you and in your particular position, and getting into the market, because you don't find the great deals unless you're buying deals that already have you, you know, in the market. So, you know, there's a lot of groups that are looking to deploy capital, but, you know, finding the deal to help them deploy that is, you know, it's not easy, but it's out there. And so, you know, my advice is always just stay in the market or get in the market. You know, if you're in it, figure out how to stay, and if you're not in it, figure out how to get in it.
Yeah.
And with that, I'll wrap it up. We're a few minutes over, but Chris, Don, John, really appreciate you guys taking the time to join us today, and everybody listening in or watching in, really appreciate you taking the time as well. I know we didn't get to any Q&As, so feel free to send emails to any of us, and we'll probably aggregate some of those emails and respond with kind of a bulk of answers to any of your questions. So feel free to submit any questions you guys have or didn't get addressed. And with that, just big thanks to everybody, and have a great rest of your week.
Thank you, Michael.
Thanks, Michael. Bye.